Good morning, friends. Welcome to our quarterly webinar on the equity markets. And with now the budget event, which is now behind us, after a lot of changes which have been there, we now shift our focus more onto the earning season, which is there. And the valuation concerns, particularly in the mid cap and small cap segment, keeps on persisting now for more than a year, having all the fund managers having a tough time deciding in terms of where and how to invest. There's a very limited upside potential, and whether there's going to be a correction, we do not know. There's a lot of focus is there on the sectoral and thematic funds, and this category has become one of the largest active mutual fund space as we speak, with the AUM in fact nearly more than doubling over the past 1 year. As regards the international markets are concerned, we have been seeing a lot of action with Japan suddenly increasing the interest rate by 250 basis points, which also resulted in the unwinding of the yen carry trade. The US data is also suggesting that it is going into a recession and now prompting the Fed to start reducing the interest rates. And also the news that Berkshire nearly sold half its stake in Apple. But despite all this, we have seen that the Nasdaq has gained nearly 7.4% from April to July in this past 4 months. The interest differential between India and US, which had has narrowed from 3.4% to nearly 1%. That's where we stand today. The interest rates in India are currently at around 6.5 compared to 5.5 in US. And despite retail inflation moderating in India from a peak of 7%, which was in May 22, to around 3.5% currently, we are unable to reduce the interest rate until there is some traction in the US, which is now based on what yesterday was announced. We expect maybe in September. As regards Indian markets are concerned, the Nifty has grown by around 12% in this past 4 months, and the mid cap is again gone up by nearly 23% and small cap by 25%. So the rally in mid cap and small cap still keeps on continuing. As far as the economy is concerned, the growth is projected at 7.2%. We are on track towards that. So it's moving steadily towards that. And as regards the FIIs are concerned, in the current financial year, in the 4 months, they have pumped in around 24,000 crores, which is in contrast to last year during the same period, we had nearly around 1.5 lakh crore, which has been pumped in by FIIs. The surprising is that the domestic institutions are completely opposite of that. So whereas they have invested, they were net buyers in this financial year, 4 months by around 1.52 lakh crore. The previous year, it was in fact a net negative of 735 crores. So we are seeing the FII and DII actually acting in opposite direction. So to decipher all this, today we have with us Mr. Niket Shah, who's the CIO at Motilal Oswal Mutual Fund. He has over more than 15 years experience in asset management and has been a seasoned player in the industry. About his qualification, he has done his MBA from Wellington Institute and also has held key roles as heading the research of midcap at MOSL, and plus prior to that being with Edelweiss and Religare. Been joined Motilal over more than 10 years ago, managing the midcap fund in 2018, and thereafter he took over managing even the flexi-cap fund. He has been promoted now as a CIO in April 24, so congratulations, Niket. And since his appointment, the fund has also seen a remarkable growth of the AUM, which has been increased by nearly around 30%. Niket oversees a diverse portfolio, and as we talk, the equity AUM is nearly 40,000 crores. And Niket just mentioned that they have crossed the total AUM of around nearly a lakh crore. So congratulations to them as well on that. So we are indeed glad that he has been able to take time out today and provide some insights to us in the space of investing in today's environment, which I am sure is extremely volatile. So over to you, Niket. Let's hear it directly from you. And as a format, we will take any questions. You can post it in the Q&A section. Uh, Over to you, Niket.
Thank you, Juzer, and thanks everyone. Thanks to the entire Ventura team for having me here on a Saturday, and thanks everyone for taking out time on a Saturday. What I would do is I would kind of run you through some of the important slides in the presentation, which I think are quite important for us to think, and it'll kind of give you a sense of how we think at Motilal Oswal and how that has really helped us to perform so much in the last 3 to 4 years. What changes have we made to our thought processes? And how are we able to do ideation much ahead of most of our peers? So let me just deep dive into the presentation. Yeah. So this is my first day when I took over as fund manager, which was 22 rupees NAV. We are right now at about 111 rupees NAV. And I think it's been a phenomenal journey. Obviously, a large part of that benefit I think should be given to markets, because the market was extremely tailwinded. And from that day till now, we've generated a cumulative alpha of more than 25% for most of our investors. So most of our funds, and this is specifically for the mid-cap fund, it's pretty much, if you look at from a performance standpoint, it's first quartile, first rank across duration now. 92% of our 94% of our AUM of the entire house right now is first quartile across duration, right? So it's not 1 year or just 2 year performance. You look at for most of the funds where there is 5 year, 7 year, 10 year, all of them is first quartile right now. And I think we take a lot of pride, and the entire team has done a tremendous effort to reach to this level. I will skip some of these charts. Let's move to the most important charts. So I think one thing that we're extremely proud as a nation is, where we are right now versus where we were in FY14, right? So from a nominal GDP standpoint, we are 5th rank versus 10th rank. Inflation is much more under control. CAD, which is current account deficit, which is nothing but imports minus export, and we were net importers. That deficit used to be about 1.7%. It's now come down to 0.7%. And our view is that with the significant amount of measures taken by the government of India to ramp up exports will yield results in the next 2 to 3 years. And India should move closer to the net surplus, which is something what China also achieves regularly. Second is on the INR side. Obviously, we have seen rupee depreciation in the last 4-5 years, but now in the last 5-6 years, we've seen rupee extremely stable, which is sign of a very, very stable country, when the rupee or the currency of the respective country is extremely stable. The interesting point which I want to keep you with is the Nifty earnings growth. So if you look at the Nifty earnings growth, right, was about 10% for the previous 10 years. So from 4 to 2014 was 10%. The last 10 years has been about 22%. Right? So that has really led to a significant amount of re-rating for the markets. Third is, I think, this whole FII inflows, right? From $13.7 billion, we are now at about $25 billion for the last 10 years. And similarly for the DIS part of it as well. So, we break this entire Modi era into 2 parts, which is 2014 to 19. The return was only 10%, primarily because of multiple measures that the government is taking at that point of time, which was demonetization, RERA, GST. All of them had some teething issues. INFS crisis, all of them had teething issues for the economy. From 19 to 24, where government really came all guns blazing on growth, we have seen roughly about 14.5. In fact, this number is now slightly higher than 15%, kind of a CAGR. And we believe the next 5 years, which is 24 to 29, we should see, I would say, closer to about, slightly higher than 15% growth, because all the decisions taken in the last 5 years are likely to fructify in the next 5 years. So is there some rhyme from 2014 which is similar to 2004 dynamics? And this, I think, is the most simplest and the most important chart of the presentation, right? And this is something that we follow very, very closely. If you look at Nifty 50 EPS from 2003 to 2008, we have seen a 25% earnings growth in Nifty. We saw a 25% earnings growth in mid cap, and we saw a 33% earnings growth in small cap. The returns in that duration was also 27% CAGR for Nifty and mid caps. and almost 35 to 36% CAGR for small caps. Fast forward to 2009 to 2018, we saw only 5% earnings growth for Nifty, 4% for mid cap, and small cap was about 3%. The return of all the three indexes was in the range of 6 to 7% from a CAGR standpoint. And now, when you look at the growth, it's bounced back to 22% for Nifty. But look at the growth in mid caps from an earnings standpoint, it's 36%. Never ever achieved in the history since the index was formed, right? This is the highest ever growth that India has seen. And similarly for small cap, which is at 48.5%. Now the returns are also closer to 40% for mid cap, about 52% for small cap, and about 25% for the Nifty as such. What does it show? It shows that the index return is very closely mirroring the earnings growth return. Over and above that, there is slight amount of re-rating which happens, and hence, every time index goes by 10%, a market goes up by 13 to 14% because there's some bit of re-rating involved there. So we believe that this is also likely to happen in stocks. When you look at stocks, and if you see a stock which is compounding at 25%, it means it will double your money in the next 3 years, which in our opinion is a phenomenal outcome, right? Because the power of compounding, which is a rule of 72, really plays through. And you are able to double your money in 3-year period. Now, if you're able to spot a company with 25% earnings growth for the next 3 years, and you're reasonably confident or the probability of that going up by 25% growth is materially higher, is something which really excites us as a house. Because for us, the threshold growth limit is about 25%. We don't like to invest in businesses with growth at less than 25%, right? One thing which a lot of people keep asking me at regular intervals is, what if another 2008 happens? Do we see another 10-year cycle where there will be no earnings growth, right? The way that we saw from 2009-10 all the way to 2020. My answer to that is no. For the simple reason is, if you look at the debt in the system today, is at a 15-year low for corporate India. The capital adequacy ratio for the banks is at a 15-year high. We are almost at closer to 16.5% capital adequacy ratio, with SBI kind of a giant being closer to 10%, right? Otherwise, if you look at most of them, ex-SBI has in fact more than close to 17%, right? So I think our capital adequacy ratio of banks is very healthy. The balance sheets or the buffers of provision the banks are carrying is very healthy. The corporate debt to equity is also very, very healthy. And the ROEs of the listed companies are now moved back to 15%, which means that, and we typically talk about weighted average cost of capital. And if most of the companies in India are able to do more than weighted average cost of capital, that's a significant benefit to all the shareholders. And last but not the least, corporate profit as a percent of GDP had gone down to 2.5%, is now moving back up to about 6%. Valuations, I think it's been talked a lot about, how valuations have been moving, and is that the reason why markets will slow down? I think there are 2-3 things when we look at valuation, right? So one is Nifty, mid caps, and small caps. So Nifty valuations today are clearly at a discount to the longer term averages. So longer term averages or a 10-year average is about 20.5. We're still at about 19.3, 19.5 range. For the mid cap and small cap, yes, the valuations are slightly expensive than the longer term averages. But you have to keep that in mind. This is on back of extremely strong growth, which we haven't seen ever in history of India. So when the growth is going to be explosive, like I told you, small cap growth was 48%. It is bound to see material amount of re-rating. And if the growth slows down, you will see returns also slowing down, which is what we are seeing right now in this quarter. That there is no material difference of returns between mid cap, small cap, and large cap. Yes, mid cap, small cap are giving higher returns than large cap, but the difference that we've seen in the last 2-3 years, that difference has shrunk because the growth has also come off. If you look at 2003 to 2008, we all think that was the biggest bull market of all times before this one started. But look at that market. There were 7 falls in that market. 2 falls of more than 30% each. right? Which was in 2004 and 2006. Yet for all of us, that was the biggest bull market of all times. So we all know that bull market needs to have correction, and there will be correction. The market can't go up all the time for 10 years, 20-year period. You will see correction. How do you take advantage of that correction is what really makes you different than most of the others who are still thinking that the market will come down more from where it is today. So अगर हम सोचेंगे कि यार मार्केट गिरेगा तब लेंगे, तो ऑब्वियसली वो एक स्ट्रेटेजी हो सकती है, बट जैसे मैंने ये चार्ट में बताया है, आपको क्लियरली दिखेगा कि मोर देन 30% करेक्शन हुआ है, और जब जब वो 30% करेक्शन हुआ है, सबको लगा यार अभी और गिरेगा यहाँ से, और वो बेनिफिट कोई भी इन्वेस्टर ले नहीं पाया है. बट व्हाट इज द गुड थिंग इज दैट when we look at retail investors behavior, we look at other behaviors from most of the other investors today, we do see investors now being very matured. Investors double up when the market goes down, right? So on the day of elections, when the market was down 7-8%, mid caps were down 8-10%, we saw the highest inflow in a single day that our fund and most of the other funds in India has also received. And that shows the maturity of the investors, that they now know that India's story is here to stay for the next 10 years. And any fall, we will embrace that fall and we will invest in markets because we are here for the longer term. This is probably the last slide of the presentation. These are some of the themes that we continue to like. And some of them have done well, we've exited, some of them continue to do well. So, one thing that we did a call, we were overweight pharma in the COVID period. But at that point of time, we looked at hospitals as a category, and we thought that hospitals will actually grow at a faster pace than pharmaceutical businesses in the next 3 years. So we went 0% weight on pharma, and we went 15% overweight on hospital businesses. All the hospital stocks in India, we were the largest shareholder by a mile. And all the hospital stocks have become 4x from where they were earlier. And the reason is very simple. As the per capita income of the country increases, we don't want to take chances on healthcare. If we have a lot of money in our hands, which I'm sure all of you will be in the next 5 years as well, we want to give quality healthcare to our families. That's our first priority. And we will not compromise on any of that. So what we are also seeing is a large amount of general practitioners where we used to go. People are now moving to specialized doctors in hospitals from a consultation standpoint as well. So I think there are a lot of value migration which is happening for hospital businesses. You see suddenly a hospital business which is only for childcare evolving in a big way, rather than a multi-brand hospital which has multiple therapies under it. So a lot of business models have evolved under hospitals. So that is one thing that we continue to like. Second is financialization, right? I think we strongly believe in that theme. We believe that in India, capital market is a very, very large theme to play for. We were very large shareholders of BSE. We were very large shareholders of Angel One. And you would have seen how the number of demat account in India continues to increase. Now, there are two ways to look at it. It's glass half full versus half empty. Half full obviously will be, the size of the penetration of Indian retail investors in India is only 8% today. US is at 65%, Japan is at 45%, China is more than 30%, and India is only at 8%, right? So you believe that this can really move up for the years to come, which obviously we strongly believe there's a significant room for that to improve as we go forward. But if you look at on the other side, a large amount of this 16-17 crore demat account statement that we have today, no one has seen a 2008 cycle. No one knows what a drawdown really looks like. So that to us also remains an area of concern. How the new 13-14 crore customers which are coming to equity markets, how they would behave is clearly an area that we have to monitor as we kind of go forward. Third is tech and tech services. I think we were the first one in India to go massively overweight on the food delivery business, which is Zomato, at about $50. We've disproportionately benefited from that investment. We continue to invest. We continue to hold still a large amount of investment. We have reduced our investment by about 25% from the peak, primarily due to the risk management practices that we follow internally. But we continue to own that balance 75%. We believe whether it's Policy Bazaar or Zomato, these are businesses which will thrive from here for the next 4 to 5 years. These are businesses where we've not scratched the surface yet. And this is once in a lifetime or a once in a decade opportunity where a company of a size like Zomato will come and become probably one of the top 10 Nifty companies in India in the next 3 to 4 years. China plus one, I think there is chemicals, there is electronic manufacturing services, there is textile and garments. Let me take a minute for you to explain our most loved theme at this point in time, which is electronic manufacturing services. We strongly believe that there are 2 or 3 large items that India imports. One was electronics, second was gold, third was crude. The government is attacked on all 3 parts, right? You would have seen what they've done on crude recently, on gold recently. There's significant amount of investment that they're doing on crude, where they're saying that India should ramp up its crude production, in gas production. Last but not the least, which is the electronics part of it. Now, electronics was the largest item in this entire universe of imports. Government has taken a very strong step for PLI in mobile phones. We've seen that, and we've seen companies like Dixon benefiting. Thankfully, when I was in sell side, I did the IPO of Dixon. And at that time to now, Dixon has just gone from strength to strength thanks to the government policy changes. But now what is going to happen is large players like Apple, large players like Samsung are looking at India from a structural sourcing standpoint. How many of you know that Apple iPhone 16 is going to be manufactured in India for the first time? No iPhones in India were manufactured ever, right? This is the first time that iPhone 16 is manufactured in India. And I can tell you that iPhone 16 is going to be probably the best iPhone that Apple has ever manufactured from a feature standpoint, right? So there are tons of features. I've got a glimpse of it. There are tons of features that Apple iPhone 16 is going to come up with. And it's extremely proud for us that India is going to do it. Let me give another data point. India has exported $1 billion worth of Apple iPhone products in April month standalone. One single month, $1 billion of export. If you analyze for this year, we would be about 12 to $13 billion of export. I met Mr. Vaishnavi recently during the election period and asked him, how do you really look at this from an opportunity standpoint? He said in the next 3 to 4 years, we will be extremely surprised negatively that if we are unable to reach to $75 billion of export only to Apple, not to the whole ecosystem, not to Xiaomi, not to Vivo, not to Oppo, but only to Apple. Imagine $75 billion worth of export happening from India, which is about 5 lakh crores of export happening only to Apple. And assuming you make 10% margin on that, that's 50,000 crores of EBITDA for Indian customers, an Indian ecosystem, Indian entrepreneurs, which I think will make a significant amount of benefit or significant amount of traction for employment in India. So this is one thing which is very close to my heart. And I believe this theme will play out for the next 3 to 4 years. And you will see 10 baggers, 20 baggers, 100 baggers coming out of this theme. Make in India, we continue to like auto plus EV. Within auto, I think everyone just wants to look at EV businesses today. We are very, very clear that EV will coincide with hybrid as well as ICE. It's not that ICE will go to zero and it will become 100% EV. I don't think that's going to happen ever. And hence, both of them will survive together. So we continue to like the EV space. Within EV, we're very, very focused. We know that there is no money to be made in the two-wheeler business and the four-wheeler business. Obviously, the two-wheeler business which just got listed has gone off the roof, but we will see how the time really plans up as we go into the next few quarters. Having said that, what we like in the EV business, we like EV three-wheelers, we like EV LCV, EV CV, and EV tractors. These are 4 categories that we continue to like. And the simple reason is because even I ride a EV. When I bought an EV, I did the whole unit economics, that how will I benefit if I buy a EV today versus an ICE vehicle. The real math is your car has to run at least 30 to 40 kilometers a day, right? If it doesn't run for more than 30 to 40 kilometers a day, you don't achieve benefit from a unit economic standpoint over the 10-year period. And the real break-even point is the 5th year, right? So if you drive 30 to 40 kilometers a day for 5 years non-stop, from the 5-year to the 10th year, you actually make so much saving that the car becomes free of cost and your 10-year logistics cost goes to zero. So that's the benefit that EV brings on table. And hence I believe cars or the vehicles which runs much more longer are the three-wheelers, are the LCV, are the tractors, because they are pretty much on the ground all the time doing either the e-commerce business or either, doing the logistics business for, when we travel in rickshaw and all of that. Second is capital goods. I was in China just 2 months back. The interesting thing that China is doing right now is making space for India at global stage. Post-COVID, most of the global giants today are looking at India in a meaningful fashion. Everyone now wants to come and invest in India from a manufacturing standpoint. And this probably is the biggest smart move done by the government, that they saw this happening and they went all out aggressive from PLI standpoint. And today, whether it's US, whether it's Europe, everyone is looking at India from a manufacturing standpoint. And this probably was the only window of opportunity to take on China, and India has done that with great success. So capital goods engineering is something, or the manufacturing theme is something that we continue to believe will do very well for the next 3 to 4 years. Infrastructure, ancillaries, renewable power. We have been the biggest beneficiary of renewable power. We are now the largest investor of Suzlon since 10 rupees. We're still holding on to it. We're not sold a single share. And we continue to believe that renewable power is here to stay and here to thrive and grow, at least for the next 3 to 4 year period. Lastly, urbanization, which is premiumization and luxury. We continue to believe every business in India today, whether you look at FMCG, you look at non-FMCG, you look at QSR, you look at real estate, you look at auto, everything grows at a higher rate if it's premium in nature. Let me give you some data points. More than 5 crore worth of real estate flats are growing at 20%, and less than 5 crore real estate flats are declining by 2% in the last 2 years, right? So it clearly goes to show that the luxury is doing very well. The luxury footwear market, which is more than 1,000 rupee ASP products, are growing at 20% in the last 3 years, and less than 1,000 rupee product are actually declining by 3%. If you look at FMCG, all the premium FMCG product, a normal soap is growing at only 3 to 4%, but a liquid soap is growing at 12 to 13%. Within categories to categories, we have seen this premiumization trend happening. And last but not the least, almost 40 to 50% of the cars sold by Maruti used to be entry level. And within entry level, I mean that, for example, it's a Maruti Swift. Within that, there are 3 levels: entry, mid, and premium. And 50% of that used to be entry levels. Today, about 25% of that is entry level, and 75% is the top level, not even the mid level. Mid level, in fact, is the least selling product. So the point that I want to highlight is, as the per capita of the country improves, people have more money in the hand, people will spend on luxury, people will spend on premiumization. Today, our market cap is about $4 trillion. In the next 3 to 4 years, we will go to $8 trillion. And with the free float and the large retail participation that we have in the country, there is going to be tremendous wealth effect in India. What do we do with that money? We will spend that money into discretionary spending, into premiumization. And last but not the least is telecom. We believe that last 10 years of telecom have been full of rough weather. We have seen telecom going through a very tough period of time in the last 10 years, primarily because of a large conglomerate coming in that business and doing price correction, playing an aggressive price war game. I think some of that is behind us now, clearly. We saw the first tariff hike increase just after election. Our view is that India needs one tariff hike every year. And we will see one tariff hike every year, because the ARPU in India still today is about $2.50 per person, which is about, give or take, about 180 to 200 rupees, versus global countries where it is more than $10 to $20 per month on ARPU. So we are cheapest. We are cheapest because of some aggressive strategies used by someone to gain market share. We now believe that most of the telecom companies who had bought spectrum in 2015 and had a 10-year moratorium to that to make payments are now going to make payments starting next year. For them to make payments, they need money, right? And the only way they can make higher EBITDAs is by increasing the ARPU, because the customer base is not growing at more than 2%. So ARPU growth is going to happen for the next 3 to 4 years. We believe companies like Bharti will be the biggest beneficiary of this entire cycle. And hence we are, ahead of the curve investing. We called out in Jan that this year is a year of telecom, and next year, and I called out recently that next year will be a year of IT. So that's broadly how we think, about, a lot of the themes that I've talked about. I would be more than happy to take questions.
Thanks, Niket. I think very crisp and very nicely presented. So I was looking at your this last chart, I mean, in terms of how you had captured the various sectors into it. What I mean, this is just so my question to you, which is emerging from that, is that I don't see any mention of banks or any PSUs. So any thoughts on that in terms of
Yeah, so good observation, Juzer. See, I think fundamentally, we believe that banks is a business which continually grows at 14 to 15% credit growth as far as the industry is concerned. I did mention in that chart that we continue to like the NBFC space. All right. So if you look at our affection is more towards the high AUM growth retail focused lenders, which is nothing but NBFC and Geo Financial today. So these are the two things that we like. But we have been negative on banks in the last 1 year. In fact, we are the only AMC in India on the MF side, which has virtually zero allocation to banks, apart from ICICI, which is very small. So from a 30% allocation on BFSI, our allocation to BFSI is only 12%. That has benefited us in a big way. One style, Juzer, that we follow is we follow earnings growth very closely. And we looked at banks last year. We thought that there was almost more than 200 basis points of repo increase happened. And that has benefited disproportionately to banks because almost 40% of the loan book is now linked to repo. So if repo increases, next day your yield increases and you benefit from that. And that has been the biggest benefit that the banks have got in the last 2 years. And we benefited from it. We were overweight banks in 2021. Now, when we look at it today, we clearly saw last year that the interest rate cycles have peaked out. The cost of borrowing is now going to inch up, which means NIMs will be under pressure. And then starting this year in September, as Fed cuts rate, RBI will also cut it and yield will come down. So you have two problems. You have cost of borrowings going up and then you will have yield coming down. And at the same time, the credit cost in the economy was only at 40 basis points for most of the quality NBFCs and quality banks. At 40 basis point credit cost, you can't go down more. You can only go up higher. So your NIM is going to come down, your credit cost is going to go up, and you have a 14-15% AUM growth on a higher base, which effectively means that you're going to grow your profit by roughly about 10% for the next 2 years, which really doesn't excite us. So whether it's HDFC or whether it's Axis, IndusInd, we have zero allocation to all of them. And we, in fact, moved an allocation to businesses like Zomato, which are growing at almost 100% plus right now, as far as the big business, Blinkit is concerned. Yeah.
At one point of time, banks was one of the favorite sectors of.
Yes. And the reason I would also like to highlight, Juzer, is that, when banks were, thriving, right? Or when we used to like banks, or where we used to like consumption businesses, the simple answer to that is, if you look at 2010 to 2020, the index growth was only 5%, whether it's large or mid. So if anything which grows at 15% really looks exciting and used to deliver very strong returns to you in that year. And hence they used to, take a bunch of limelight, right? If you look at 10 to 20, why HDFC Bank did so well in that 10-year duration is because most of the PSU bank were in PCAs. They were not allowed to lend. And hence a large amount of quality only went to HDFC Bank. And HDFC Bank was the biggest beneficiary of that cycle. And hence was a darling of the street. And so was Bajaj Finance. But now if you look at today, all the PSU banks are thriving. And look at what's the return that Bajaj Finance and HDFC Bank has given. Because when some of these PSU banks were available at 0.2, 0.3 book with almost 100, 200% kind of a profit after tax growth, we saw a massive re-rating in all of them. And where did that money came from? People sold Bajaj, people sold HDFC, moved to PSUs, and then PSUs continue to do very well. So I think we have to keep in mind that there are cycles at all points of time. Nothing does bad for a disproportionate period of time and nothing can do well for a disproportionate period of time. And we have to play through those cycles. Let me give you one last data point. When I took over the fund at that time, the world was shut. It was very difficult to figure out what to buy, what to sell. There was no intelligence at that point of time. If you call any companies, if you call anyone for doing channel check, he'll say, boss, घर पे बैठे यार, कुछ नहीं हो रहा है, बंद है world यार, क्या हमको भी नहीं सोच रहा क्या होगा. So at that point of time, whatever in basic common sense appeared, we did it because we said that every day we're using Zoom. So IT will do very well, hopefully, right? Everyone has to embrace IT, right? So we went over with IT at that point of time. Now, IT did very well for that next 12, 15-month period. We bought Persistent, we bought Coforge, we used to have LTI Mindtree at that point of time. They went 3x, 4x in just a matter of 12, 18 months. Right? That is where the extent of the cycle was. Because every employee of IT company was sitting at home. IT companies had no visa costs, no cost structure of offices, and they had massive top line growth with much better pricing than a normal environment, because clients are saying, boss, thoda zyada le lo yaar, but kaam karke de do. So IT companies saw a significant amount of margin expansion, very strong earnings growth in that duration, and IT companies did very well for us. In December 21, we re-looked at IT. And if you look at a September to December fact sheet, you would have seen that we exited IT, we went to 0% weight in IT. Because we said, now it's going to reverse. Now offices are going to open, visa is going to happen, you have to do travel back, and the growth will come up because everyone has over-invested ahead of the curve in IT. So we went to 0% weight in IT. And IT didn't do well for the last 2-year period. So we benefited in a big way. The money that we sold in IT, we went overweight on banks, and we went overweight NBFCs, and we went overweight on capital goods. Now, capital goods did very well from that period. We bought CG Power at $20, and we've exited almost most of it at about $650. So we made 25 times return in one single stock with very high allocation. And a lot of other smaller, I would say smaller or mid-sized capital good companies is where we made disproportionate return because the whole industry went through a roof, right? And if you look at in 21, the environmental clearances by government of India were at a 10-year high. It was visible in data that was capital goods tsunami is coming. And we went overweight capital goods, we went overweight banks. Last year, we went out of banks. We went zero on banks. And the money which came to us, we said was, let's look at real estate now. Because we believe instead of increase in interest rates, real estate is not slowing down, and specifically on the luxury side. So we went and focused on prestige. And he said, this guy is going to move to Mumbai. This guy is going to Delhi, which is a better market with premium market, higher ASP market. And we bought prestige in 1 year, we made 4 times return. And as we see real estate slowing down right now, we are out of that stock with zero weight for us. So when I sold banking last year, we went overweight, real estate and food delivery businesses, all the consumer discretionary names, Kalyan, Zomato. Now those have become 5 times, real estate have become 4 times. We are out of real estate completely. Now we are out of capital goods completely after making 20 times return. And what have we done with that money? We've gone back to IT because we believe now IT is going to come back. So I think it's very important to play those cycles, very important to play those themes at the right place, right time, identify those themes, within that themes, what stocks to buy, right? Now, when you buy a right stock, you also have to think when to sell that stock. You can't buy and hold till eternity, which is what the mistake that we used to do in the past was buy right, sit tight, बेचेंगे ही नहीं share. Now, we realized that was a fundamental error. And I said, boss, it can't happen to do that because we have to move out of this. Otherwise, we can't play cycles. So we bought something. When we identify a theme, within that theme, what stocks to buy, sell that stock at the right time. Once you sell that, move to the next theme. Within the next theme, what stocks to buy. And you keep doing that virtuous cycle all the time. And I think you will continue to do very well in the marketplace, irrespective if it's a bull market or a bear market.
So I think somebody had a question on view on real estate. So I think you have addressed that that you, as far as you are concerned, you are out of real estate, right? I mean, so Amarnath, you can ask. Then I will ask some questions from the audience.
Thanks, Niket. I'll try to move slightly away from the bottom up sector selection, stock selection, which you have elaborated in great detail and superbly, to move towards this whole thing of cash flow, money, fund flows into the markets. So I think there's been some recent data that first half Jan to June 2024, about 1 lakh crores was cashed out by promoters in rupees terms.
Yes.
And I think even in the last week itself, which was kind of a record week, I think the week which just ended yesterday, I think about 20,000 crores was cashed out by promoters. So, even the 1 lakh crores amounts to almost three months of the MF equity inflows, right? Even if you go by the latest 40,000 kind of number. And there is now talk that, the second half of FY25, we are going to really see the tsunami or deluge of IPOs, the big daddies, the GEOs and Reliances and, others coming in, and numbers vary anywhere between 1 lakh to 3 lakh crores over the next 6 months. And FIIs possibly still turning a bit positive, but whether they would come in a big way. So how do you think that the fund flow dynamics is going to impact the markets over the next 6 months?
Yeah, so thanks for the question, Amarnath. So I think I want to make 2 points. I think there's this whole notion in the market that mutual funds have about 1.3, 1.4 lakh crore cash today. That number is correct. In fact, it's slightly higher than that, but the number is correct. But I want to also make a point that 1.3, 1.5, 4 lakh crore, whatever the number is, it doesn't mean that tomorrow market's correct, entire 1.4 will go in. At all points of time, all funds keep 3 to 4% cash as a buffer at all points of time for a bad day, or for redemptions, or for any big event that happens, right? So you keep 3-4% cash. If you remove that, the available surplus to be invested is about 75 to 80,000 crores, give or take. It can be closer to 90,000 crores as well, give or take, right? So that's the first point. Second point is, I think we look at all SIP data. SIP data says that, we are seeing 22,000 crores of inflow. No one knows the net number. The net number is about 8 to 9,000 crores in our opinion. So we see 8 to 9,000 crores of inflow. We are also seeing a lot of people booking profits at regular intervals, right? To your data point that you highlight, India has seen about 6.5 lakh crore of inflows on mutual fund side post-COVID. And at the same duration from 21 till now, FIIs have seen only $9 billion of inflows post-COVID. We don't see this number slowing down anytime in the near future. We see this number continuing. In fact, the first correction that happens, the number suddenly accelerates. I see on days where the market goes to 2%, that is, the inflow that we get on that day is materially higher than the normal day period, right? So people are just, waiting for even that smaller blip today to come and invest in markets, right? Second point that you allude to is promoter selling. Now, it's an interesting conversation I keep having with most of the promoters, right? Who sell their stocks or their own holding in equity markets. And the question to really ask is that आप share बेच देते हो, आपने लाख करोड़ का माल बेच दिया सब promoter, वो लाख करोड़ गया कहाँ पे? कहाँ तो गया होगा? किसी ने घर लिया है, किसी ने गाड़ी लिया है, कुछ तो किया होगा. If you look at it, in my sense, about 75 to 80% of that money has gone back to investment only. It's come to people like us. We have been beneficiary of that. It's gone to someone other like ICICI Pru. All of the mutual fund guys have been beneficiary of that. किसी ने PMS में पैसा दिया है, कोई private transaction कर रहा है. So हर किसी को लगता है कि यार मेरे लाइफ का तो इतना पैसा कैसे बन गया? और हर किसी ने family offices चालू कर दिए. So where is that money gone? That money is not gone and lying in the bank in fixed deposit. That money has gone back to equity market, maybe from his own stock to something else. And which might not be a bad strategy because any promoter today thinks that in the last 15 years, I have not made any money. This 4-5 years has been the biggest tailwind for India. And my valuations have gone off the roof. Let me cash in something and let me diversify my own personal portfolios as well. Today, any promoter, including our promoter, the biggest wealth is his own holding in the listed company, including Ramdevji, right? But Ramdevji also has a large amount of investment in the mutual funds business. About 9,000 crores of investment today on the MF side is by the promoters. Now that is a complete, I would say diversification strategy from their holding on Motilal Oswal. Because when you give me 9,000 crores, that 9,000 crores spread across all the stocks. That doesn't mean he doesn't like Motilal Oswal, right? But it's a diversification strategy that all promoters use from time to time. But having said that, there are some cases where the promoters have sold, and we do believe that the promoters are very, very smart. No better than the promoter knowing about his company than even us. You can do research for 15 days. The promoter has lived that company for the last 25 years. So promoter selling is obviously a sign of worry. And we do believe that in the next 4 to 5 years, as and when there is a major correction, these promoters will come back into buying some of their own stock. So I think we have to look at, you have to bisect and dissect. You can't generalize it that sub promoters based matlab, look at Polycab here. They sold their first stock at 3,500. Today the stock is 6,500, right? And the kind of changes that has happened to business model or the external environment which has gone changed, they never thought this is going to happen, right? Otherwise, why would have they sold at 3,500 if they knew it's 6,500 is going to come? At the bottom, let me tell you, in COVID, I used to speak to so many management. And everyone used to give a very bleak picture. No one thought कि 4 साल बाद ऐसा दिन भी देखने मिलने वाला है. So while promoters obviously are ahead of the curve, they are much more smarter because they know their business is much more better. Some promoters are cashing in, which is a sign of, which is a red flag for us. But we are not generalizing that for the whole India. कि यार सब promote जो share जो company में promoter ने share बेचा उसका share हम भी बेच देंगे. हम ऐसा नहीं सोचते हैं, right? Because बहुत बार ऐसा होता है कि promoter को diversify करना है.
Yeah, I'll just add, extend one more question based on what you said. Is that so? Where do you think that in terms of valuation or whatever, the promoter or the managements could think differently in terms of अभी हमको अपना share buyback करना है. So do you see any sectors, any stocks into that territory yet, or you think it's nothing is there available at that in that
So if you
domain?
if you look at just yesterday, there's a public domain information again, so I can share. We bought a large chunk in Kalyan. We were very large holders in Kalyan since $100, but we just added a bit more. And the promoter also bought about 2,000 crore worth of Kalyan yesterday and increased his stake by 200 basis points. So there are companies where we are seeing promoters where they're confident of the next 3-4 year growth coming and still chipping in. There are companies where we are seeing promoters or smaller cap side where promoters still doing some creeping acquisition, although the number is smaller than the guys who are selling. I think some of these promoters will come back two ways. One is time correction. There has to be some time correction for markets, which we strongly believe will happen right now as we are talking. We believe India is going to consolidate. India is not going to correct by 25%. If anyone thinks India is going to correct by 25%, is like dreaming here. Someday something is going, material is going to change. I mean, that's astrology, but not fundamentals, right? So our view is that India will go through a time correction. This quarter was the lowest earnings growth in 16 quarters. India saw only 5% Nifty earnings growth and about 6% growth for mid caps. Slowest earnings quarter by a significant mile. And we believe even next quarter is going to be slow. So when earnings growth are slower, because of a lot of factors, you will see market returns also being slower or no returns. And when you have 1 or 2 years of no returns and a business, say like, let's take an example of Polygon, it continues to grow at 20%, 25%. At the end of the second year, the valuation of that company automatically comes down because the stock is at the similar levels and the earnings have gone up by 25% on a compounding basis. That is where I think promoters will really think of chipping in back again. Or if there's a correction in price, the promoters might think to chip in back again. So these are the only two areas where I think it will happen, where I think promoters will chip in back. So in a bad environment, if you have say another 2008 kind of a situation, you will see some of these promoters flooded with cash coming in and doing creeping in their own businesses.
Thanks, Niket.
Juzer, you're on mute.
There was a few questions even on the chat for this. Now you had also floated a defense fund, and now defense as a sector. So defense, railways, and metal. These also three did not appear in anywhere in your sheet. And also the thing is that like, do you also think that that investors should look at thematic as a fund, or a person should still stick to the basic core of large, mid, small? What is your view on that?
Yeah. So let me give you another example, Juzer. Last year, same time, some of our funds took a call to move out of the micro cap names that we had at that point of time, right? Just because some of my fund managers thought that valuation is expensive, and I thought some of the sectors, the valuation was much more expensive. And we've reduced our allocation to some of the micro cap names. So if you look at our average market cap of our holdings has only moved up in the last 1.5 years. At the same time, our passive trade came and told me that, hey, we should launch a micro cap fund because that is a part of the market where there is no product and there is a lot of inward demand for that product. And hence I said, okay, if there's inward demand, we'll launch it. And we don't launch a product keeping in mind next 3 months, 6 months, 6 months karenge product band karenge. Aisa to hota nahi hai. We launch a product for years. We want to launch a product which is now launched and there for eternity, right? At the same time, when we launched that product, when I used to travel for roadshow for that product, everyone used to tell me, sir, ये कोई time है launch करने का? इतना market बढ़ गया है, कोई time है? And I used to tell everyone the same thing. We don't time anything. For us to launch a product requires talent. If we get the talent, we launch a product. We believe in 10-year India story. So अभी इतना minutely time करने जाएंगे तो we will definitely miss the big canvas that India has to offer, and we'll think very narrow. Hey, aaj girega tab launch kare, kal badega tab launch kare. So we'll keep thinking that way. That is why we don't spend time, and that's something which I have to completely give it to Ramdevji. Ramdevji teaches us that never give up on India, right? आप India पे give up कर दिए तो बोला fund management में give up कर दो फिर, right? Because then you can't think constructive, right? Every year one Nifty stock doubles, so that's the way that we look at it, right? So we have to identify that. So I think for us that is extremely important that we don't try to time a product. Now from that day till now, right? That product that we launched, right, has given 95% return, right? And some of our stocks, some of our managers also had exited out of that 500 to 750 in terms of market cap category, right? And all those investors today whom I meet again say that, wow, sir, what a timing. I said, boss, we never time again. It was just a luck that we launched it and it is gone up by 95%. Who knows? We don't launch it for a year. We launch it for 5 years. Similarly, when we launch a defense fund, we thought we should launch it for the 5-year period. We don't launch it for a quarter or so. We run an active management. We run an active mutual fund. We have to move out of certain stocks into certain stocks. Our job is when we, for example, when I sold banking last year and I went to real estate, from the prices I have sold banking, they are up by 25%. But my real estate stock is up 400%. I am in business of making more money for my investors, not in business of making less money for my investors in good quality stocks. Quality is non-negotiable for us. We follow the QGLP philosophy very closely. We don't dilute on quality. But within that quality framework, if I get a stock X, which is going to give me higher return than stock Y, I will have to sell Y to move to X. So defense has done very well for us. Even in our schemes, we used to have defense. We believe there will be some consolidation phase, and hence we book profit in defense and move to something else. Now, if that something else does very well for next 1.5 year, 2-year period, we will move out of that and come back to defense. There's no problem in it. We don't believe that the theme is dead. If you're a Prime Minister of India today, what is the top thing in your mind? Think, close your eyes and think if you're Narendra Modi for one day, the top thing in your mind is today borders and geopolitical, nothing else. Right? Country is doing very well. GDP growth is more than 7.5%. Inflation is under control. Forex reserve are very high. All of that is hunky-dory. Right? India is completely secluded by whatever geopolitical risk that we are seeing today. Right? But the concern that the Prime Minister would definitely have, that I have borders with China and Pakistan. And that's something that he has to prepare. And that's why 3 years back, they went all out on defense. So is there any country in the world which can reduce their defense spend today? I don't think so. So we believe that this story is there for the next 3 to 5 years. And hence, I think we should play that from a 3 to 5 year standpoint. So that's why it is not launched in the active side. It's launched on the passive side, right? On the active side, the thematics that we will launch, we will not launch any thematic fund which is very narrow in nature, right? Because what happens in active, if the theme really dies down, then the customer doesn't end to make money. So we give that in passive as a customer as an option. If he feels he wants to have 100% exposure to defense, here is a product for you. In active, we will launch themes which are much more broad based. We launched the multi-cap fund. We just launched a balanced advantage fund, which got ended yesterday. We will launch a digital fund shortly, right? Which digital is a very broad theme. We have already launched a manufacturing fund, again, very broad theme. So we are launching thematic funds, but very broad theme, no narrow theme. Manufacturing, there are 7 themes: auto, EV, cables, renewable powers, capital goods, infrastructure, power utilities. There are multiple things on manufacturing, mobile component manufacturing, all of that. So if one doesn't do well, we'll move to something else and we'll still do very well in that theme. But if you have a very narrow-minded theme that we launch on the active side, then we will tend to, not give a good experience to the customer. So all the smaller themes will go to passive, the broader themes will come to us. That's how we've cut it.
Amarnath, you want to ask anything?
Yeah, I would, again, switch hats to wear the politician's hat, since you mentioned about, the Prime Minister and what engages, his attention the most. I mean, I think there's one view emerging, particularly since the election results, that there have been some instances of, are we slowly going to have to go back to what was the, if I may use the word, a kind of the India curse. They used to say that rollbacks, you take 2 steps forward, then 1 step backward. We have seen a few instances, not very material, but yes, it is raising that doubt. So what, in your view, would that have an impact on potential FII flows? And the we have seen re-rating of many sectors. Could it also result in a bit of de-rating now over the next? Again, it's a 1 year view that one is asked.
Yeah. So which areas are you specifically highlighting? Where 2 steps forward and 1 step backward?
I mean, I think we specifically, if you see, we have had things like, there was this lateral hiring thing, which was seen to be a very positive thing, which has been sort of taken back, right? As one example. Then you had, the thing on the capital gains on real estate, etc., which was announced in the budget. We have never seen the budget going back ever in the last 8-10 years, but it was something which was going back. So maybe some of them are necessary as part of a democracy.
Sure. So I think it's a good question. Let me answer that question, and we've debated that internally as well. So we have a very strong consensus view on that, but happy to get other views as well. We fundamentally believe that every politician is also a human being, right? And what do you want from the government is a question that we all have to think internally. What is the perfect government? First of all, there's nothing perfect. Even I'm not perfect, even you're not perfect. None of us are perfect, right? We all have some good strengths and some weaknesses. What is the thing that we want from the government? We want government which is very, very strong, decisive in nature, thinks for the country first, right? Keeping all countries' aspiration first, and do reforms which are in interest from an investment standpoint, right? Reforms which benefits not only the government's kitty from a taxpayer standpoint, but also the taxpayer itself should get some relief so that he is able to, save something and grow from it, right? Now, I think this whole debate about capital gains tax on real estate, so on and so forth, I think the government realized that there was a confusion and there was some section of society which clearly got impacted if the indexation benefit was taken. And I think they've come back saying that, hey, we have heard most of them. There have been a lot of representation made, but there's a lot of confusion which is getting created because of this, and it's impacting the real estate sector. And it's quite an important sector for us because it cuts across verticals, steel, cement, all of them depends on real estate. And hence it's quite important for us that we reduce that confusion, and hence we'll allow both, right? To me, it doesn't sound two step forward and 1 step behind. To me, it sounds a government which is very nimble. It's like all of us, we buy stocks. And I keep telling all my fund managers today in office, you buy a stock today. If you realize you made a mistake in 10 days, please sell at a loss on the 11th day. Please. Don't allow that underperforming tree to grow bigger. You realize your mistake in the 10th day, no problem. We are all human beings. We are not God. You realize a mistake, please liquidate it. Please book your loss. And now think properly when you invest the next stock. Right? So it's very important that if you think you've done a mistake, roll it back. There's no problem. No harm in it. It's a sign of a government which is very open to feedback. It is a sign of a government which is very, very nimble. And there will be mistakes, right? I'm not saying no government is perfect. Every government will make mistakes. So I don't think that way. I think they are very, very nimble. They do listen to people on the ground. There have been enough and more feedbacks being given to. In fact, I can tell you a lot of feedback had been given to them on the consultation process to the budget. A lot of that has been accepted by the government. So it is not that everything that the government announces in the budget is their own ideation, is the ideation from the industry. They speak to industry people, speak to people on the MF side, speak to people on the corporate side, take their feedback. Whatever thing they think is valid and it's relevant to do it, they do it. So I think a lot of the decision making from the government has happened because of consultation. Even though you look at PLI schemes, a lot of consultation happens with the industry players that, hey, we are looking at this. Is it going to be feasible? Is it good enough for you to bridge the gap between China and us? Is it going to make you competitive at global scale? Now, if they do something and then they realize, hey, we did this, but it was a mistake, should we roll it back so that to ensure that now we were in the right track? Then I think that's a sign of nimbleness and not going 2 steps forward and 1 step behind.
Thanks, Niket.
Thanks, Niket. I think there are still a lot of questions coming in, but we also have a paucity of time, and I think it was a really excellent session. So I think I'll just take one. In fact, we had more poll questions, but I'll take only one, and I think which most of the people would want it to be, relevant to see after hearing you. Where do they see, the Sensex was at 72,000 on 1st Jan 24. Currently, we are at around 81,000. So where do you see it by the end of December 24? So we asked this to the audience that do they see it, below 81,000, above 90,000, or between 81 to 90,000? So just we can also try to see based on what they have heard you talking, what do they feel now? So you'll also get an idea that how whether the investors are bullish or bearish. Because if there will be a dip, you will get money. That's what you say, right?
Yeah.
Uh, So, but I think it was an excellent session in terms of as people complete, I'll just try to sum up. I think due to paucity of time, I liked your slides. When you had that getting the house in order was the period between 2014 to 19, and then the reform-led impetus of 19 to 24, and now we should see the continuity of the reform. The first phase gave a return of around 10%. The next was around 14%, if I remember it correctly. And
Yes.
now I think we should hope for something which is going to be 14 plus. So going forward with a 5-year horizon, right? And very good slide which I saw in terms of the earnings growth, which we saw, in terms of over a very, very longest period, that where we had a flat earning in the Nifty stocks, the mid cap and the small cap, and now suddenly we are seeing even the earnings growth. So even though valuations may appear to be a little high, but they are not very frothy in terms of like we can say that they are overstretched. I that's what I believe is what you're trying to say, right?
Yeah.
Yeah, and even in terms of we don't see a 2008 type of a moment. Our capital adequacy ratio is healthy. The corporate debt to equity is also quite healthy. The return on equity is good. The corporate profit to GDP is now nearly at 6%, which was hovering at around 2.5. So stick to high quality, high growth. I loved your chart of the sectorization rather than the traditional sectors. It was more what you had made into like was healthcare, financialization, tech and tech services, China plus one, make in India, urbanization and telecom. So that itself was also very helpful. And just taking it from your very first slide, where you had maintained that we are in a mini Goldilocks moment. So while you were talking, I just did a little bit of a Google search. Just to explain to people that a Goldilocks moment basically means a steady economic growth accompanied by low inflation and a market-friendly monetary policy. And I think that's what we are headed towards. We are having a steady economic growth. We are having a low inflation, and in fact, our monetary policies have been, applauded world over. So, and as we see, I'll just end the poll. We have 56% of the investors who think that the markets will be between 81,000 to 90,000. So we will see. Hopefully, at the end of December is when we will come to know. So thank you everyone for participation, and thank you Niket, for taking time out. A very, very interesting session. So thank you once again.
Thank you, Juzer. Thank you, Amarnath.
Thank you. Thanks.
Thank you, the entire Ventura team. Thank you.